Hello friends, if you like to open Demat account, you can make use of the link available in description. In the fundamental analysis series, totally 10 videos were uploaded. This is the second video. If you didn't watch the first video, that video link is in description. Please watch the videos one by one so that it will be easy to understand the concept and so that you can easily do the fundamental analysis. In this video, we are going to see some other basic financial terms and also accounting equation. In the balance sheet of all the companies, a basic accounting equation will be available. That is, equity plus liabilities equal to assets. In this accounting equation, in right side, the term asset denotes the total asset value of the company. Next, in the left side, the term liabilities denotes totally how much loan a company had taken. That is liabilities. The term equity will be otherwise called as total equity, total capital, owner's fund or shareholders fund. All these terms will give the same meaning equity. In simple, equity means in any company how much worth of the asset belongs to owner of the company. In case of listed companies, owner means not only the promoters, all the shareholders also will come under owners category only. So that only the equity was also called as shareholders fund. For example, let me assume that I was going to start a company and for starting that company, I need 1 crore rupee as investment. But I have only 80 lakh rupees in my hand. So, for remaining 20 lakhs, I was going to take loan from the bank. Now, I had started that company. My company's total asset value is 1 crore rupees. But in that total asset value 1 crore rupee, how much worth belongs to the owner means that is only 80 lakhs. Because I had put only 80 lakhs in that business. We can substitute these values in this accounting equation now. Asset means total asset value of the company. So, the total asset value is 1 crore rupees. That 1 crore I had entered in assets. In the left side, we has to balance this. That is, owner had put only 80 lakhs to start the company. So, that 80 lakhs I had entered in equity. Next, owner had taken 20 lakhs loan. So, that 20 lakhs I had entered as liabilities. In this accounting equation, now I had taken the liabilities to the right side. If someone is asking me what is the worth of your company, like that means to that person, I cannot tell my company's worth is 1 crore like that. Because liabilities has to be deducted from the total asset value. So, the term equity is indirectly known as net worth of my company. In Basics of Stock Market series, I had used this formula. That is, net worth of the company is equal to assets minus liabilities. In simple, if I want to tell means, the term equity denotes net worth of the company and also the term equity denotes how much worth of the asset belongs to owner of the company. Both are same. In that example, let me assume that in the end of first financial year, my company had got profit 20 lakhs like that. From the profit amount of 20 lakh rupees, first I will settle the loan of my company. So, now liabilities will become 0. The total asset value of my company is 1 crore rupee. So, I had entered 1 crore in the term assets. Now, my company's asset 1 crore rupee minus liability 0. So, equity I will get as 1 crore rupee. That means at the end of first financial year, net worth of my company had raised to 1 crore rupees. Let me assume that in the end of second financial year, my company had got profit 30 lakh rupees like that. Now, my company don't have any liabilities. So, that profit 30 lakh rupees will be credited in my company's bank balance. The bank balance of the company also will be considered as asset. So, the total asset value of my company had increased from 1 crore rupees to 1.3 crore rupees. Now, my company's asset 1.3 crore rupees minus liabilities 0. So, equity I will get as 1.3 crore rupees. That means at the end of second financial year, net worth of my company had raised to 1.3 crore rupees. Now I had opened Money Control website. In Money Control website, if you search by any company name, you will get all the data about that company. I was searching Reliance Industries Limited. In the top, if you click the link financial, below that you can find many links like balance sheet, profit and loss account. In that I had selected balance sheet. This is the balance sheet of Reliance Industries Limited. Here all the numericals will be mentioned in crores. In Money Control website, last 5 years data will be mentioned. But if you check the annual report of any company, only last 2 years data will be mentioned. So Money Control website will be more comfortable for doing analysis. In any company's balance sheet, these two major titles will be available. That is, first equities and liabilities, second assets. Within these two titles, many subtitles will be available. Under the title Equities and Liabilities, if you scroll down and see at the last row, a term total capital and liabilities was mentioned. Here, capital is nothing but equity. In the year 2020, total capital and liabilities of Reliance Industries was 9,68,900 crore rupees. Similarly, under the next title assets, if you scroll down and see at the last row, total asset value will be mentioned like this. In the year 2020, the total asset value of Reliance Industries was same 9,68,900 crore rupees. This is the accounting equation. For all the companies, these two values will be always balanced. The term equity will be divided into two categories. One is share capital, second is reserves and surplus. In Basics of Stock Market series, I had mentioned a term authorized capital. Authorized capital and share capital, both are more or less same term only. Share capital means for starting a company, how much money the owner had initially invested. That is share capital. Let us take the previous example. For starting my company, I had invested 80 lakhs from my hand and 20 lakhs I had taken loan. So, totally I had invested 1 crore rupees for starting my company. So, that 1 crore rupees will be considered as share capital of my company. Next, we will see about reserves and surplus. In simple, if I want to explain means, in every year, a company whatever profit it earns from the business, that profit will be added in reserves and surplus. Not only profit, losses also will be added in reserves and surplus only. Like in previous example, my company's total asset value is 1 crore rupees. So, I had entered 1 crore rupees in the asset. In liabilities, I had entered 20 lakh rupees because I had taken 20 lakhs loan from the bank. In the left side, in place of share capital, I had entered 1 crore rupees because for starting my business, totally I had spent 1 crore rupees. Any company's share capital value will not change often. In some of the rare situations only, share capital value will change. In which situation share capital value will change, that I will discuss in end of this video. In accounting equation, if I balance both the side, I will get reserves and surplus as minus 20 lakhs. Because now only I had started my business. So there will not be any profit from my business initially. But initially I have 20 lakhs loan. So that only my reserves and surplus is in negative. Let me assume that in the end of first year, if I get 20 lakhs profit from my business, then first I will settle my loan. So in the right side, my liabilities will become 0. Next, asset will not change. It will be same 1 crore rupees. In accounting equation, in left side, share capital value is same 1 crore rupees. That will not change. Next, the company, whatever profit it earns from the business, that will be added to reserves and surplus. So, I am adding 20 lakhs to the reserves and surplus. With minus 20 lakhs, if I add plus 20 lakhs, then I will get 0. In the end of first year, my company's reserves and surplus is 0. Now, in the end of second year, if I get a profit of 30 lakh rupees from my business, then in the right side, my asset will increase to 1.3 crore rupees because I don't have any liabilities. So, that 30 lakh rupees will be added to my bank balance. In this 1.3 crore rupees, 1 crore will be the asset value and remaining 30 lakh rupees will be the bank balance. In left side, what changes will happen we will see. Share capital will be same 1 crore rupees. That will not change. Next, second year profit 30 lakh rupees will be added to reserves and surplus. That I have entered in reserves and surplus. In my company, let me assume that I was starting a second project like that. And let me assume that for starting the second project, the total cost required is 50 lakhs like that. But my company's bank balance was only 30 lakh rupees. So additional 20 lakhs I will take loan from the bank and I will start the new project. Now what changes will happen we will see that. My company's total asset value will become 1.5 crore rupees. That is old asset value 1 crore rupees plus new project asset value 50 lakh rupees. Total asset value will become 1.5 crore rupees. So that 1.5 crore rupees I had entered in asset. For starting the new project, 20 lakh rupees I had taken loan from the bank. So in liabilities I had entered 20 lakh rupees. In the left side, share capital value will be the same 1 crore rupees. Now if I balance both the sides, reserves and surplus will be the same 30 lakh rupees. Normally, in any company's balance sheet, whatever amount they had mentioned in reserves and surplus, by seeing that amount, you should not conclude that that amount will be in the form of cash in their hand like that, because it may be converted in the form of asset also. In left side of the accounting equation, if I add both reserves and surplus and share capital, I will get total equity as 1.3 crore rupees. That means total asset value of the company may be 1.5 crore rupees. But in that 1.5 crore rupees, only 1.3 crore rupees worth of asset is belongs to that owner of that company. Remaining 20 lakhs is under loan. That is remaining 20 lakhs is under liabilities. Now I had opened balance sheet of Reliance Industries Limited. In balance sheet, here they had mentioned total shareholders fund of Reliance Industries Limited. Here, total shareholders fund means nothing but total equity. You can see that year by year there is a nice growth in the total equity of Reliance Industries. This is a positive sign for that company. In accounting equation, liabilities were split into two types. First is current liabilities, second non-current liabilities. In any company, what are the liabilities they has to repay in the current financial year, that will come under current liabilities. And what are the liabilities they has to repay from the next financial year, that will come under non-current liabilities. For my company, let me assume that in the year 2020, I had purchased one four-wheeler like that. The price of that four-wheeler is 5 lakh rupees and I had purchased that four-wheeler using my credit card. So that next 5 years I has to pay EMI. That is, in the every year end, I has to pay 1 lakh rupees as EMI for next 5 years. At the end of the year 2020, I has to pay first EMI of 1 lakh rupees. Remaining 4 lakh rupees I has to pay for the next 4 consecutive years. The 1 lakh rupees which I has to pay in the current year, that comes under current liabilities of my company. Remaining 4 lakhs which I has to pay in the future, that will come under non-current liabilities. Similarly, assets also splitted into current assets and non-current assets. A company's bank balance will come under current assets. Next, in a company, what are the products which are convertible into cash within the current year? That will come under current assets. Next, what are the products which are not convertible into cash within the current year? That will come under non-current assets. Let me assume that I have one automobile company like that. If my company's bank balance is 30 lakh rupees, then that will be mentioned under current asset. In my company, whatever automobiles which are ready for sales after the production work, that will also come under current asset. Addition to that, in my company, whatever raw materials available, that will also come under current assets only, because that raw materials will be converted into automobiles and that also will be ready for sales in this year itself. So that will also come under current asset only. My company's land, building, machineries, furnitures, all these will come under non-current assets, because I am not going to sell these assets, and these are the assets which are going to support my company's production work. So these will come under non-current assets. Next we will see how to calculate the actual profit of any company like that. In my automobile company, let me assume that I had sold totally 100 automobiles and one automobile price is 1 lakh rupees, like that let me assume. Then my company's total revenue will be 100 automobiles into 1 lakh rupees. Totally 1 crore rupees will get. Total revenue will be 1 crore rupees. From my company's revenue, first operating expense will be deducted. In the fundamental analysis series previous video, I had discussed both capital expense and revenue expense. In that, revenue expense is nothing but operating expense. In simple, if I want to explain, means operating expense is nothing but whatever amount the company had spent for regular operation of business, that is nothing but operating expense. For example, raw material cost, labor cost, electricity bill, marketing expense, all these will come under operating expense. Addition to this, the amount invested for research and development also will come under operating expense only. But company's machine cost will not come under this operating expense. That will come under capital expense. Let me assume that operating expense of my company as 30 lakh rupees. So from total revenue 1 crore rupees, if I deduct 30 lakhs, then balance I will get 70 lakh rupees. From the revenue, operating expense is deducted means that balance amount is called as EBITDA. EBITDA is nothing but earnings before interest, tax, depreciation and amortization. That is nothing but EBITDA is the earnings of a company before deducting loan interest, tax amount, depreciation amount of machineries and amortization value. In companies, how depreciation and amortization value is calculated, we will see now. In companies, there are two types of non-current assets. First is tangible assets, second is intangible assets. Tangible assets is otherwise called as physical asset also. In a company, what are the assets we can touch and feel that? That will come under tangible assets. In a company, what are the assets we cannot touch and feel that? That will come under intangible assets. So that only intangible asset is also called as non-physical assets. In a company's non-current assets, building, machineries, equipments, vehicles, furnitures, all those will come under tangible assets, because these are all physical assets. We can touch and feel that. In any company's non-current assets, software license, copyrights, patent rights, if you buy any brand name for your company, all these will come under intangible assets, because we cannot touch that and feel that. In every year, tangible assets value will get depreciate. That is nothing but depreciation. Similarly, intangible asset value also will get decreased year by year. That is known as amortization. The machines in my company will not work for lifelong period, because all the machines will have certain life period. For example, let me assume that I had purchased machines for my company for 1 crore rupees, and let me assume that the life period of that machines as 10 years. That 1 crore rupees, if I distribute evenly for 10 years, I will get 10 lakh rupees for every year. That means at the end of first year, that machine's value will depreciate from 1 crore rupees to 90 lakh rupees. So depreciation value is 10 lakh rupees in every year. In every consecutive year, the depreciation value of the machines is 10 lakh rupees. So at the end of 10th year, that machine's value will become 0. Suppose if my company used that machine after 10 years, then depreciation value after the 10th year will be considered as 0. Like depreciation, same concept is applicable for amortization also. For example, if my company purchase a software license, let me assume that software license cost is 1 crore rupees like that, and 10 years validity for that software license like that, let me assume. Total software value is 1 crore rupees. From that, software value will decrease every year by 10 lakhs. So, every year amortization value is 10 lakh rupees. After 10 years, software validity will finish and for further usage, I has to purchase newly. Let me assume that my company's depreciation and amortization value is 20 lakhs for this current year. Then, from EBITDA, 20 lakhs deducted means I will get balance 50 lakh rupees. After deducting depreciation and amortization from EBITDA, I will get EBIT. That is earnings before interest and tax. This EBIT is otherwise called as operating profit of the company. That means a company how much efficiently it creates profit from the core business. That can be understood from this operating profit. That is EBIT. For any company, input means how much amount totally the owner had spent on the business. That is the input. In simple terms, input is nothing but total expense of the company. Total expense means capital expense plus operating expense. Next, output means the company's revenue is considered as the output of the company. In this calculation, first we have deducted operating expense and next we have deducted depreciation and amortization. This depreciation and amortization indirectly means the capital expense of the company. In any company, from output minus input, we will get operating profit of that company. That is nothing but EBIT. This EBIT is one of the best parameter to compare two companies, and from this parameter, we can easily find out which company is more efficient on their business like that. Next, we has to deduct interest amount. Let me assume that my company had taken loan from the bank and for that loan I has to pay 20 lakhs interest like that, let me assume. If I deduct 20 lakhs from operating profit, that is EBIT 50 lakh rupees, balance I will get 30 lakh rupees. This 30 lakh rupees is my company's earnings before tax or profit before tax. We can also call this as taxable income for my company. Company tax is 30%. In 30 lakh rupees, 30% means 9 lakh rupees will come. This 9 lakh rupees I has to pay as tax for the government. From 30 lakh rupees, if I deduct 9 lakh rupees, then balance I will get 21 lakh rupees. This is the actual earnings of my company. That is, profit after tax is 21 lakhs. While doing fundamental analysis, this is one of the important parameter, that is profit after tax. If any company's profit after tax is increasing year by year, then it is a positive sign for that company. While doing this calculation, in the depreciation part, I can consider only tangible assets like machines, equipments, vehicles, furnitures, but I cannot consider land. Because land value will not depreciate. Instead, its value will appreciate. Next, we are going to see the term EPS, that is earnings per share. My company's total earnings after tax is 21 lakh rupees. If I divide this value by my company's total number of shares, then I will get earnings for one share of my company. That is nothing but EPS. Let me assume that my company's total number of shares is 1 lakh. So, earnings after tax is 21 lakhs divided by total number of shares 1 lakh. I will get 21 rupees. That is, my company's earnings per share is 21 rupees. That means my company's one share had earned 21 rupees profit from this year. That is the meaning. Similar to EBIT parameter, this EPS parameter is also very important while doing fundamental analysis. If any company's EPS value is increasing year by year, then it is a good sign for that company. In accounting equation, total equity is nothing but the net worth of the company. If I want to calculate worth of one share of any company, then I has to divide total equity by total number of shares of that company. From this formula, I can easily calculate the worth of one share of that company. Let us take a small example. Let me assume that a company's total equity as 1 lakh rupees and that company's total number of shares as 2000. Then total equity 1 lakh divided by total number of shares 2000. I will get 50 rupees. So worth of one share is 50 rupees. This is also called as book value. That is, book value is nothing but worth of one share of that company. This company's one share worth is 50 rupees. But by paying 50 rupees, I cannot buy this share. Because at which price this share is trading at the share market, at that price only I can buy the shares. At present, this company share may be trading at the price of even 1000 rupees. Book value shows the actual worth of one share and market price shows the worth of that one share in the market level. In share market, some company shares market price will be much higher than the book value. Similarly, some company shares market price will be lower than the book value also. How it happens we will see now. For example, X and Y. Like that, let me assume two colleges and let me assume that these two colleges have same size of land, same infrastructure, same facilities they have. Like that, let me assume. This shows that the net worth of these two colleges will be same. So, if net worth is same, then book value of that two colleges also will be same. Let me take these two colleges in different way. That is, college X have good management like that and college Y have poor management like that, let me assume. So, if college X management is good, then college X admission will be also good and profit also will be good. But college Y management is poor, so that college Y admission will be less and so that college Y will have big loss. In this situation, all the investors will have interest to buy the shares of college X only. So that demand will increase and finally market price of college X will increase higher than its book value. But there will be no demand for college Y shares. So that market price of college Y will be equal to its book value or maybe less than its book value also. Next, we will see the simple formula for three types of capital used in share market. First is share capital. Share capital means how much amount a businessman had spent for starting the business. That is share capital. Share capital formula is total number of shares into face value of the share. Here, face value is nothing but the initial value or historical value of the share. Next term is total equity. Total equity means net worth of the company. Here, in accounting equation already we have seen the formula total equity is equal to assets minus liabilities. One more formula is total equity is equal to total number of shares into book value of the share. Here, book value is nothing but actual worth of one share of that company. Third is market capital. The term market capital means value of the company in market. That is market capital. Market capital formula is total number of shares into market price of the share. Here, market price is nothing but shares LTP. Now, I had opened the balance sheet of Reliance Industries. In this video, previously I had told that share capital value will not change like that. But here, when compared to the year 2017, the share capital value of Reliance Industries got doubled in the year 2018. How this happened we will see now. In the year 2018, Reliance Industries announced 1:1 ratio bonus shares. So, Reliance Industries total number of shares got doubled. Because of that, share capital value also will get doubled. Let us take a small example. Let me assume that one company's total number of shares as 1000 and face value of that company share as 10 rupees. So, share capital of that company is total number of shares 1000 into face value 10 rupees. We will get 10,000 rupees. So, share capital of that company is 10,000 rupees. In the next year, if that company announces bonus shares in 1:1 ratio, then that company's total number of shares will become 2000 shares and face value will be the same 10 rupees. So that now share capital of that company will become double. That is, that company's share capital will be 20,000 rupees. That company, for announcing 1:1 ratio bonus shares, first that company what they has to do means that company has to allot rupees 10,000 from the profit of that company to share capital, and remaining profit will be added to reserves and surplus. Similar to bonus shares, if any company brings further public offer, in this case also company will create new shares. So that for creating new shares, that company will raise the share capital value. Before watching the third video, please open 2 or 3 companies' balance sheet and profit and loss account statement and see all the terms what I had discussed. In our channel, we have prepared totally 8 videos in the concept of basics of stock market. Please watch those videos for understanding the basic terms in share market. All the videos link are in description. In this video, if you have any doubt, please make a comment, I will reply.